Regulations in the US and Europe, including Dodd-Frank, EMIR, and Basel III, require standardized and most OTC derivative trades to be handled via clearinghouses, which will stand behind these trades in the event that one of the counterparties defaults. Users of these derivatives will need to post initial margin with the clearinghouse. The initial margin requirement by the CCP is usually in the form of liquid securities, for example, cash or government bonds. Trading firms will be required to provide variation margin depending on fluctuations in the trade's value, and the majority of these margin calls will only be done in cash. The problem is that many derivatives users, such as hedge funds, pension funds, or mutual funds, will not have sufficient eligible collateral to satisfy the margin requirements. The dilemma or shortage in collateral is the main driver behind the creation of the collateral transformation market. Collateral transformation is an activity typical of repurchase agreements or repo and securities lending. Few firms have led the pack in terms of designing offerings in this realm, but there's still a significant shortage, so other firms that did not consider building these capabilities post the regulatory reform era are now trying to figure out how they can best leverage their existing capabilities to offer collateral upgrade services to their clients. Now let's take a look at the demand numbers. An estimated 65 to 70% of the total annually traded volume of OTC contracts will be cleared this year, creating an additional collateral requirement of between $3.5 trillion to $4 trillion. Within the next 4 years, an estimated 80% of OTC contracts would be cleared by CCPs, creating an additional collateral requirement of $6 trillion. Further, changes to capital requirements that were introduced under Basel III and Solvency II will raise demand for both high-quality assets, also known as HQA, and some debt instruments that are secured by collateral assets, such as corporate covered bonds. The Basel Committee estimates that the full implementation of the LCR, or liquidity coverage ratio, will also increase the demand for high-quality assets by $1.3 trillion. A number of firms have built out collateral management, optimization, and transformation capabilities to assist their clients with this new demand. However, that's not enough, since dealers, which are also clearing members, cannot do unlimited amounts of collateral transformation. Most dealers we talk to say they would only have the capacity to extend credit lines and provide collateral transformation services to a fraction of the recently created collateral requirement. Firms that have not considered joining the collateral transformation market back in 2010 and 11, when we first started working with clients on this, are now planning to offer collateral transformation facilities, essentially enabling clients to post non-eligible instruments with, let's say, the dealer or custodian that's providing the collateral transformation service, which will be then switched into cash via the repo and securities lending markets, and then posted with the CCP. We believe that certain firms that are late to the dance are exceptionally positioned to offer collateral transformation services, as they have access to idle, high-quality inventory, repo markets, and securities lending. Now let's take a look at these firms and their collateral transformation perspectives. First, we'll start off with broker-dealers and larger regional banks. For large banks, regulatory compliance is both the main driving force and restraining force behind business strategy. Over the past few years, regulatory pressures have forced these firms to re-engineer their derivative franchises and business models, which has exerted significant pressures on their profitability and depressed their return on equity numbers. That being said, collateral transformation is a great place for them to seek further profits. A major concern with transforming assets into cash is that it requires firms to use their balance sheet. And given what we know about the capital and liquidity constraints that are caused by regulations such as Basel III, dealers will need to meticulously price their balance sheets usage appropriately. Next, we have global custodians. Since collateral transformation is similar to repo and securities lending markets, custodians can leverage their existing capabilities to offer collateral upgrade services to their custody clients. Custody banks are well positioned to provide such a service since they routinely help optimize their clients' collateral and help facilitate and settle trillions of dollars worth of repo trades. Since custodians hold collateral pools, it makes sense for them to bundle clearing, collateral enhancement trading, and collateral management functions as one service. That being said, we've seen the largest global custodians become general clearing members, or GCMs, to compete with the prime brokers, but there's still much work to be done in order to fill the collateral gap. Next, we have CCPs. CCPs are essentially the market maker for collateral transformation services based on the types of collateral that they're willing to accept based on the regulatory requirements. That being said, the CCP's principal directive is central clearing. By providing collateral transformation services, this could cause a conflict of interest with the CCP's main function. If CCPs are starting to engage in collateral transformation and collateral transformation-like services, and effectively accepting less liquid collateral, this will diminish the demand for collateral transformation and effectively circumvent the regulations we discussed in the introduction. This disconnect between CCP policy is also clear that they wouldn't be able to transform collateral because of the regulatory barriers for CCPs. For example, collateral acceptance policies are not uniform between the US and Europe. Finally, there's a significant wrong-way risk involved if CCPs were to offer outright collateral transformation. Imagine the impact of an equities clearinghouse offering collateral transformation, effectively upgrading equities instruments for cash, and then a subsequent scenario where the equities market crashes while the CCP is still holding the client's illiquid collateral. Another common question we get asked is, will we see non-traditional players that are cash-rich lenders emerge as collateral providers? Not likely. Non-traditional but cash-rich lenders, such as corporations and non-bank financial institutions, will not enter the market in great numbers, as these institutions have historically preferred the predictable yield and tenor of fixed income securities. Even with negative interest rates looming around the world, the infrastructure setup cost and regulatory attention these firms would attract make this a riskier offering for these firms, and makes the risks effectively higher than a reward for them to engage in these markets. However, we might see pensions and money market funds that fall outside the scope of the Basel framework and thus face fewer restrictions engage as a new source of market liquidity for collateral transformation. Obviously, firms looking to gain a competitive advantage should capitalize on all the new regulatory requirements and market needs by offering bundled services such as custody, collateral management, collateral transformation, execution, clearing, and other services that are required throughout the trade lifecycle. But when we look at profitability figures in the collateral markets, collateral transformation stands out as the most profitable. For firms that want to avoid the operational hassle and cost of setting up a one-stop shop for the entire trade lifecycle, we recommend they focus on collateral transformation. Now, that being said, they can't offer collateral transformation without first having collateral management and collateral optimization systems and processes in place. So one more thing that we should go over before we wrap up: requirements and barriers to entry in this market. There are four main requirements for offering collateral transformation. The first one being performance. Firms must obtain a comprehensive view of the collateral portfolio's overall composition and performance results across all asset classes, including the identification of performance drivers for the portfolio and industry benchmarking. This is typically done through what is called collateral optimization. The second thing is technology infrastructure for collateral management and collateral transformation. The technological undertaking for offering collateral transformation is not a simple one. Firms must have a cohesive architecture that combines data management, collateral management, flexible business rules, matching algorithms, compliance, and risk measurement. Risk measurement is done across things like counterparty risk and market risk, in addition to reporting and monitoring requirements. Firms must build out this infrastructure in order to get a detailed picture of the collateral's overall composition, characteristics, performance and risk, including performance attribution and traced cost analysis, across all asset types, from traditionals to alternatives. The third thing is risk management. The ability of one firm to post collateral that it borrowed from a different entity does not make the trade or system less risky. It merely transfers the risk. So identification, measurement, and management of multidimensional risks is imperative throughout the entire collateral upgrade lifecycle, from a position-based perspective all the way to a return-based perspective. Additionally, firms that venture down the collateral transformation route should be wary of liquidity risk concentration. The fourth thing is compliance. Firms should also be cognizant of regulatory risk and compliance by monitoring collateral's adherence to specific guidelines, market requirements, and regulations. To conclude, collateral transformation is a unique opportunity for firms that have a relative ability to convert collateral via securities lending and repo markets, and firms that have access to collateral pools that could be through corporate institutional banking, custody functions, in addition to wealth management functions. Before jumping into collateral transformation headfirst, firms should consider creating client-specific collateral transformation business cases to define the specific collateral needs and requirements. Then map those business cases against Opimas' collateral revenue model that we went over, and opportunity map in order to determine what their penetration rates and potential market share would be. From there, firms should identify any gaps and potential roadblocks for collateral transformation offering across performance, systems, analytics, risk, and compliance. Thank you.